Hey, it's the bear. So, let's do another introduction, this time to class preparation assignment number 8, and go through some of the principles here. First off, a black swan is here. We're going to talk about black swans as part of what we're doing, and we are in the middle of one right now, and I think it's actually going to get a lot worse. Yes, just a quick review. Behavioral finance. Lots of biases out there, and one of the strongest is recency bias. Recency bias is everywhere. Yes. So, right now, a lot of people are rethinking, for example, their risk tolerance because the market is way down and people are less tolerant of their risk because of recent events. Yes. Today we're going to cover strategic asset allocation. Can we time valuation shifts? Can we use something called tactical asset allocation? We're going to talk about stock market valuations and how they affect future expected returns, black swans, and the efficient markets hypothesis. So, asset allocation, as we know, is the art and to some degree the science of combining different asset classes into one single portfolio. There's no perfect portfolio out there. There's a lot of different ways of combining asset classes, but certainly there are things that we can do that for the very long term give us a higher probability of outperforming, for example, just the entire stock market or the entire bond market or the like. All right. Strategic asset allocation is where we set targets for what each asset class should have. And these are established, they don't vary a lot. Basically, if the client's financial situation changes, there might be a change. If there's a huge change in the markets, for example, 2001, when I started, we were typically projecting fixed income investments that fixed income asset class would earn about 5.5% in our clients' portfolios. And after 2008, that really went away. And now we had to project a lot lower. So because of that lower returns for fixed income investments, now 2 to 3%, as opposed to 5.5%, that might not be able to obtain the client's goals as a result of that. Therefore, there might have to be a change in the client's strategic asset allocation. Sometimes we might find a new asset class. I'd like to include that. For example, the Swan ETF. I've included in some clients' portfolios, and in some respects, it's a fixed income allocation. In another view, it's really its own asset class from the standpoint of its characteristics. You can see here on this chart that a broker dealer typically likes to assign different labels to things, a conservative versus a balanced versus an aggressive growth. I don't really like those labels, but you can see as it becomes a more aggressive portfolio, there is more stock and less bonds and short-term instruments. Somebody might call that cash. Here's just another way of looking at it. This one is an aggressive, moderate, and conservative investor. 90%, 70%, and 50% allocation to stocks. Moderate investor is 70%. If we go back and look at moderate, it is 40% allocation to stocks. So what people call moderate varies. These words aren't very good in my view. Yeah. If you don't change your portfolio, let's say you started in December 31st of 2008, and you were 60% stocks, 35% bonds, and 5% cash, and you never touched the portfolio, you never rebalanced it, what would happen just 6 years later? It turns out you're at 75% stocks because stocks went up over this time period, even though beginning of 2009 was a downturn. And basically your portfolio, if you look at the bottom of this little graphic, your portfolio goes from moderate risk to a higher risk. So really the main purpose of rebalancing is to keep your risk level the same. So what is portfolio rebalancing? Here's an example. All right. At the beginning value of this portfolio. We have four different asset classes. They total $1 million. And then after 1 year, we have a return of plus 20%, minus 10% for another asset class, 5%, 5%. The total return of the portfolio is on average 5%. And then we actually put aside dollar amounts to those returns. So the first asset class went up by 50,000. The second asset class went down by 25,000. The third and fourth asset classes went up by 12.5. And we end up with different values in each of these asset classes. And what we want to do is rebalance the portfolio. So if we started with four equal asset classes, we just want to divide the new total of the portfolio by four and do some trades to basically sell, take some gains off the table in asset class 1 and buy low in asset class 2 since it's gone lower. And then we ended up with a rebalanced portfolio at the end. Rebalancing, does it add to returns? Well, it actually adds what we call a rebalancing bonus because you're forcing yourself to sell high and buy low. Of course, it could go higher and it could go lower, right? But from the standpoint of 25-year holding periods, you would think that rebalancing doesn't really help as opposed to doing nothing. And the reason is, if you don't rebalance, over time your stock allocation, because stocks outperform fixed income investments, your stock allocation is going to get higher and higher and higher over time. So basically, only when the markets go down significantly over 25-year periods would you really see rebalancing actually having a better return as opposed to not rebalancing at all. And that's basically what this chart says. There's a lot of red in this chart. Rebalancing leads to lower performance of the portfolio. There are a lot of 25-year periods when rebalancing actually worked pretty well. Basically, this just points out that rebalancing doesn't necessarily aid in performance, and most of the time hurts performance, but it's really about maintaining the desired level of risk in a portfolio. If I had not rebalanced client portfolios from 2008 through 2019, when the market generally went up since March of 2009, and my clients were much more allocated to stocks, had much greater percentage of stocks in their portfolios by the end of 2019. And then what we've seen happen in the first 3 months of this year, boy, those clients would have been upset with me because they would have been much more risky than they should have been. Right. Strategic asset allocation, did it work? Did basically putting things in different asset classes work? Back in the great financial crisis, 2008 to 2009, if you had a very well diversified portfolio of commodities and REITs and US stocks and foreign stocks, all of those asset classes suffered declines of over 50%. And that led to a lot of people to say modern portfolio theory is dead, which I don't agree with. Never have. So what did work was holding US Treasury bonds in that period of time, and that added quite a bit in terms of the returns of the portfolio. Tactical asset allocation is different. Right? Tactical asset allocation, you basically say to the manager, you have a range of percentages in each asset class. For example, you could put 40 to 50% in stocks, depending on whether you think stocks are going to outperform versus other asset classes. So these are minimum and maximum acceptable percentages. All right, so you're basically undertaking a form of market timing and trying to figure out which of the asset classes are going to outperform. And here's just an example from one firm of strategic versus tactical. A strategic asset allocation, an example is 20% equities, 20% cash, 60% fixed income. And then the tactical, there's a range of returns. The manager could be anywhere between 15 to 25% equities, 15 to 25% cash, and 50 to 70% fixed income. All right, so as long as, of course, the total portfolio has that up to 100%. In this case, the manager says that the tactical asset allocation is more expensive than the strategic. Actually, I don't see a lot of that in terms of fee schedules with a lot of firms. Here's just another one that basically says, what is the process of tactical asset allocation? We analyze the trends, we allocate more to rising markets, we reduce our exposure to weak markets, and we adjust to new data. And of course, they probably say they have some way of figuring out if markets are going to go up or if they are weak. Yeah. Here's just another way of doing it, quantitative analysis. We're going to calculate the long-term expected returns. We're going to look at our economic themes. We're going to look for pricing differentials. We're going to examine bottom-up stock growth data. On top of all that, we're going to look at macroeconomic risk. We're going to test downsides, and then we're going to figure out where we ought to be. More than 75% of investment advisors surveyed by Sorelli, which is a firm that does a lot of surveys in the investment industry, believe that active managers can offer downside risk protection through tactical trading. And in fact, President of Colphuff Investment Advisors said there are two ways to generate growth: make more than the market and lose less than the market in down cycles. Active management proponents say that they can lose less in downturns. Yeah. What's interesting is there's really no data that kind of backs that up, that on average, tactical asset allocation results in lower return, higher or less of a loss during market downturns. And in fact, the Morningstar tactical asset allocation category, so Morningstar's got rates all of these funds, it groups funds into asset allocation. How did it perform basically relative to just a standard 60% large cap stocks and 40% bond index? And Morningstar did a study of this and found that these funds gained on average an annual return of 7.8%, but that was 3.8% behind this benchmark. Those findings were nothing new. 2016, Morningstar did it again, saying tactical funds have generally failed to have delivered better risk-adjusted returns. And again in 2016, they readily adjust their asset mixes in response to current market conditions. They are a sucker's ploy. And in fact, we watched in class a video that basically, or in prior a prior video from me, where we basically saw that Vanguard had abandoned its tactical asset allocation fund, concluding that it was not adding value. Why is tactical asset allocations difficult? So difficult. Well, part of it is the premiums from factor-based investing are strong. If you're going to get out of the stock market, or if you're going to reduce your allocation to the stock market, you're giving up equity risk premium there. So you have to make two really good decisions when you're giving up that premium. One is when to get out, and the second is when to get back in. Remember all those behavioral biases we have? They creep in there too in terms of this decision making. So it's really hard to overcome not being exposed to certain factors and trying to time those factors. There's very little evidence that that can be done. However, I tell you, if you type in tactical asset allocation and do a Google search, you will come up with all these different firms that do tactical asset allocation. If you type this up in an academic research database, you will find all of these papers, most of them written by managers of mutual funds, basically saying, we have a technique here that does tactical asset allocation. And again, you can't disprove tactical asset allocation because literally there's hundreds of different types of tactical asset allocation. There are new theories being published all the time. But in the standpoint of papers that prove tactical asset allocation, it's not just one paper, but several papers where they take the same technique and apply it in very broad data sets and different data sets. You rarely, if ever, see that. So let's talk about valuations and future returns. When asset class valuations are high, future long-term returns tend to be lower, and vice versa. So, one of the things I've emphasized with my own clients recently during the downturn is don't worry. Your retirement is not jeopardized. How much money you can pull out of that portfolio is not really jeopardized. And the reason is this: when stock prices go down, the expected returns over the next 15 years, the average annualized expected return that we estimate, actually goes up. So basically, the return of your portfolio is going to be higher, and therefore it doesn't significantly affect what you're likely to do. Now, I would say that if there's an economic downturn that's prolonged, that's not good for the economy in the short term or the long term. You know, basically have less economic growth over a period of time, and that's not good for anybody, not good for anybody's portfolios. But what we're talking about is an impact probably in the 5 to 15% range in terms of total economic growth over a long period of time. Valuation is all that matters in the long term according to this chart. This is normalized PZs, predictive power on S&P 500 returns, and it basically says for a holding period, all right, what is the probability that the returns will be higher when you have a lower PE? And what you see is that over the short term, the predictive power of where the normalized PE ratio is relative to what's going to happen over the next year, 3 years, 5 years, 7 years, not a lot of predictive power, 40% or less. But when you get out here to about 10 years or more, the predictive power becomes quite strong. It's about 80 to 90% predictive power. Here is the Shiller 10 EY, basically the PE ratio reversed in essence, versus the actual 10-year returns that we're seeing. So basically, you take the Shiller PE on one side of the graph and the actual 10-year returns on the other. You plot them together. What you see is that when the PE ratio of the Shiller PE is relatively low, all right, then actually the EY is low, which means the PE is high, all right, then you're for the next 10 years you're going to have lower returns. So there's a strong correlation there that occurs. The strongest correlation appears about 16 to 17 years out. You can see that the chart, just compared to the prior chart, there's some wiggle room there in terms of the correlations. But when you come here, the correlations out to 16 years are really strong. And that's one of the reasons that when I do my own estimates of future returns, I like to use 15-year averages for assuming a reversion to the mean will occur in estimating returns because of the higher predictability out at 15 years or so. This just shows emerging markets index price to book value ratios, all right, and it shows that there is a trend line here, okay. So when price book ratio values are lower, all right, you get a positive returns, and when the price book ratios get higher, the returns tend to be lower and negative, all right. So but if you look at that chart, there's a lot of variance in that chart. Here is price to sales ratios. Price to sales ratios is often said by some to be the best predictor of future 10-year returns or even 15-year returns. And this graph kind of illustrates that. Here's the ratios as a predictor over a 10-year period of time. Much stronger predictive value for the price sales ratio. But price to cash flow, price to book are pretty strong as well. Price to free cash flow, I'm surprised that is so low. Price earnings, I'm not too surprised because prices and earnings can both fluctuate greatly. All right. So what can we conclude from all this? Current levels of market valuations are a fairly good indicator of future long-term returns for stock asset classes, but they're really a poor indicator of what's going to happen next week, next year, even over 3 years, 5 years, or even 7 years. It's really when we get out to 10 years or longer that we have pretty good predictive power. Not certain predictive power, but pretty good predictive power. And when I use expected returns data for different asset classes, I'm not using it to time the market at all. I'm not using it to adjust asset allocations to become tactical. I'm really using it for financial planning purposes. how long will it take to reach a goal in terms of savings, or how long will this portfolio last? Do we have enough return in it to generate the cash that the client in retirement will need? Yeah. A lot of financial planning software fails to incorporate current valuations into their models. And I actually see this in financial planning firms that they don't change expected returns very often in their models. They just assume a certain rate of return, which I disagree with. I think if you're going to use financial planning software and use it to project future returns, you have to take into account valuations. Black swans, yes. Nobody ever saw a black swan until Europeans went to Australia. Of course, the native Australians knew what black swans were. And what is it? It's an occurrence that deviates beyond what is normally expected and is extremely difficult to predict. And this term was popularized by a book written by Nassim Nicholas Taleb. He's a finance professor and former Wall Street trader. And he basically, black swan events are random and unexpected. All right. So we can actually look back through fairly recent history and identify what we might call some black swan events. One is what's called the Asian financial crisis. Basically, it's a series of currency devaluations that occurred and reduced a lot of revenue in a lot of Asian countries, South Asian countries, and as a result of that, international stocks tumbled as a result of that. Okay, the dot-com crash, when basically the tech bubble burst. A lot of people viewed that as a black swan. Nasdaq index, which is a very tech-heavy index, lost 78% of its value. Um, Overall, the stock market was down, I think, somewhere around 40-50%, something like that. Yeah. 9/11, certainly a totally unpredicted event. Stocks plummeted. The S&P was down 11.6% in the first trading week. That's large cap stocks in the U.S. Interestingly enough, of course, the stock market was closed for that week. I believe 9/11 was on a Monday, and basically because of the damage done in the Wall Street area, which is close to where the planes impacted, it took a week to get the stock market reopened again with new cables and power and all that. So they basically just closed the entire stock market for a week. The global financial crisis, or what's called the Great Recession, when Bear Stearns nearly collapsed, it was taken over, when Lehman Brothers filed bankruptcy, when AIG almost filed bankruptcy, bailed out by the U.S. government. Basically, that was often viewed as a black swan event. It's not that any of these events were totally unpredictable. There are a few people who predicted these events, or at least predicted that there was a risk of these events happening. All right. But these are events that the majority of investors, the vast majority of investors, uh, either did not know that they would happen or did not know when they would happen. For example, everybody can say, "Well, there's going to be a virus or some type of bacterial infection. Could be like the plague, and it's going to happen someday because we haven't figured out, how to combat these things very well." Well, nobody could actually say when that was going to occur, and of course it has occurred now. So, black swan events are huge stock market declines that are largely unpredictable, can occur at any time. If you're withdrawing money from your portfolio in retirement, this can hurt you. All right? You would be selling your portfolio at lower values. As a way of countering that, it's basically looking at your portfolio as like layers of a cake, the top layer being short-term cash, the middle layer being middle-term investments, and the bottom layer, a bigger layer being long-term investments. And whenever the market's down substantially, you just take out the short-term, the top of the cake. All right. If you're adding money to your portfolio, the downturns are a good thing. So every month that goes by, out of my paycheck, a lot of money goes into stock mutual funds. And I'm like, hey, yay, I'm doing well. Yeah, because I'm able to buy cheaper now. Yeah. Of course, my wife looks at the portfolio values that have gone down. She's not very happy. And I say, don't worry. So we're not retiring tomorrow. At least hope not. Okay. So let's actually take a look at what's happened here during this black swan event. Okay. Uh, I chose a lot of funds from Dimensional Funds Advisors. That's the fund company I like to use. And what we find is some interesting things. Large growth stocks didn't do as bad as large cap value stocks. Remember when I said during significant recessions and depressions that value stocks do worse than growth stocks? That happened again. And small cap value stocks did worse than large cap value stocks. And again, small cap growth was down, but small cap value was down even further. On the international side, large cap growth versus value stocks. Again, large cap growth did better than a balanced portfolio or the international value. And in the small cap growth area, small cap growth stocks did worse than large cap growth stocks, but again, small cap value was the lowest. And actually, right now, small cap value stocks, both in the US and overseas, are tremendously undervalued relative to historic norms. And probably not at the bottom, certainly not, they could go lower, but they are quite undervalued. But there's also more risk there, and part of the reason is that small companies, again, don't have as much access to capital during downturns. What's interesting about the $2 trillion stimulus that the U.S. government enacted is there's a lot of loans available from the Federal Reserve, backed up by the U.S. Treasury, to large companies. But small companies are getting forgivable loans just to maintain people on their payroll. They're not getting a lot of other loans that they need to basically survive. Yeah, and even if they got those loans, their revenues may not be sufficient in the future to support repaying those loans in some cases. So small companies, smaller companies, small businesses generally, weren't treated very nicely as a result of this stimulus package. Hopefully, they'll have another stimulus package and that will change. But we're going to see a lot of small businesses go under this, and the smaller the business, the more likely it will be to go under. Remember, nobody has a crystal ball that consistently works for picking individual stocks or for trying to time the market. All right, I have a view right now, all right, that the stock market is likely to continue going down over the next 2 months. All right, I would not use my own personal view and manage my clients' portfolios, for example, by trying to time the market. All right, uh, because I know that I am subject to a lot of biases, behavioral biases, and I'm not certain of that. All right, but I do know that strategic asset allocation with rebalancing, which is a very disciplined way of reacting to market events, that it works. Okay, let's explore the efficient markets hypothesis. We have basically three forms of the efficient markets hypothesis. And as we study these forms, we have the weak form, then we have the semi-strong form, which incorporates the weak form, and then we have the strong form, which incorporates both the semi-strong form and the weak form. So, what is the efficient markets hypothesis? We're going to define it. We're going to discuss the three forms of efficient market efficiency, and talk a little bit about random walks as well. So basically, the efficient markets hypothesis, which was given its name by Eugene Fama, all right, is the theory that market prices are fair. I didn't say rational. I said that the fair security prices reflect all of the available information about that security. And since the 1960s, this has been probably the most important paradigm in finance and the world of investing. All right. And whether markets are efficient has been extensively researched, but still remains controversial. If you want to start an argument, if you want to start a vibrant discussion when you go to an industry conference full of investment advisors, just say out loud in the room, active versus passive. Yeah, you'd be amazed what kind of conversations result. Now, what type of efficiency we're talking about is not operational efficiency, how well things function, how well production process happens, for example, all right, or how well trades are executed, all right. What we're talking about is informational efficiency, how quickly and accurately the market reacts to new information coming in or the available information that's out there. And that's the type of efficiency that we're talking about. And the efficient markets hypothesis says that the stock market, or bond markets as well, are informationally very efficient. That the price of an individual stock or bond adjusts fairly rapidly and fairly accurately to the new information that comes out about that company or about that investment. But it's not completely efficient. All right? The market's not completely efficient. All right? So Eugene Fama originally said that there were three forms of market efficiency based on the level of information reflected in security prices. The weak form says if you just look back at the past prices, each day, what was the price, each hour, all right, and you look at that in the volume of trading in that stock, the weak form efficiency says you can't use that price information and volume information to basically outperform the market just using that information. The semi-strong form says that all publicly traded available information, for example, a stock analyst comes out with a report saying, we think this company is going to have great earnings in the future, or there's news out about a company. This company had a really good quarter, or it entered into a huge contract with another company. That you can't use that type of information to basically outperform the market. And then we have the strong form that basically says, there's some people inside the company that have inside information, like the president and maybe the board of directors and some of the officers, and that the prices reflect all of that privately held information as well that could affect the value of securities. And you can't make profits based on privately held or inside information. So let's explore the weak form a little bit better here. Basically, it's charting. The weak form says it's impossible to predict future prices by analyzing prices from the past. The current price is a fair one, and if you look at the past price data, prices going up, prices going down, that you can't really use that information to outperform or underperform in terms of selecting individual stocks. And there's a whole industry out there that uses charting. And basically the weak form there's no use in predicting stock prices using charter. For example, which stock is a better buy? Stock A has been going down in price, stock B has been going up in price, they're both at the current same price. Which is a better buy? The weak form says neither is a better buy, that they're both equal. All right. According to the weak form of the efficient markets hypothesis, neither stock, because the current price reflects all past information. Now, charting, people who study charts of all the pricing data, then called technical analysts. You'll see technical analysis suggests that the market will continue to go down or something like that. And these people are also called chartists. All right? They look for patterns in the sequence of past prices. All right? And there's a lot of behavioral finance behind some of this. All right? So, for example, this is a cup and handle pattern. So we have basically the price of the security going down and then going up, and then we have it going down, and you see the handle there, and oh my gosh, it is time to do what? Well, based on this cup and handle pattern, and you see all these types of patterns in the market, there's either a sell or a buy signal. Is this really anything to it? And there's a lot of books written about this. There's a lot of seminars that you can go. You can go online and learn all about charting. And even Mad Kramer says technicals can help augment your investing. And tonight I'm eyeing some of the best chartists out there. Well, let me kind of set the record straight here. Okay, technical analysis is bunk. It is absolutely foolish. All right. Around 20 years ago, most of the large Wall Street firms actually fired all of their technical analysts at the time. Why? Because they found out, based on their research, technical analysis did not add any value at all in terms of improving the results of a portfolio. However, you see a lot of brokerage firms still have technical analysts on there. And what they do is they're basically saying buy or sell, buy or sell, buy or sell. Well, buying and selling helps brokerage firms because that's how they make money. And that's why you see a lot of technical analysis out there. All right, there is one of over two or three hundred patterns that have been discovered in the market. There is one pattern that actually has some predictive ability, and we've studied it. It's momentum. If a stock's price has outperformed the market over the last 6 to 9 months or 9 to 12 months, it is likely to continue to outperform the market at least until the next earnings reports come out. And the same thing, if it has underperformed, it is likely to continue to underperform for the next 3 months or until the next earnings report comes out. But that's on average, all right? So momentum basically is the one charting technique that actually has some academic validity to it. And as we've explored some of the behavioral finance reasons behind that in the past. Now let's turn to the semi-strong form. All right. The semi-strong form that security prices fully reflect all publicly available information, where information comes out about companies all the time. Companies announce their earnings every quarter. If you're publicly traded, you file reports with the SEC about your quarterly earnings. And that information is available to everybody instantly. Yeah. You also make perhaps some press releases. You might have a conference call. And nowadays, when you have a conference call, for example, chief financial officer, chief executive officer of a publicly traded company has a conference call, that call has to be open to everybody. So so you're not just giving information to just a few people. All right. Basically, the semi-strong form says that all of the economic reports, brokerage firm recommendations, investment advisory, all of the opinions about the stock that are publicly available are incorporated into the price. All of the press releases that have come out, all of the observations, all of the news that comes out about a company. And in addition, it incorporates the weak form, so it also says all past stock prices. So remember, semi-strong form also incorporates the weak form as well as all of this other information. And in fact, the leading paper on this was published in 1969. Eugene Farmer was the lead author of that paper. The adjustment of stock prices to new information. Yep. Academic research sentiment strongly supports the semi-strong form, and that basically means that investors are seldom going to beat the market by analyzing news and opinions and things of that nature. Stock prices incorporate this new information very rapidly. All right, and the reaction of stock price to new information, if it's an efficient market, what you see in the green line is that the market, here's the price of the stock. The news comes out. It's bad news, and basically it reacts very quickly to that. Now there is an overreaction to bad news with reversion, and there could be a delayed response to bad news. All right. So sometimes that overreaction occurs. Remember, we talked about the fact that momentum could exist, especially when you have bad news comes out and it's re-emphasized, or good news that's re-emphasized 3 months later, that there might be an overreaction to that. That's one of the behavioral reasons behind momentum, for example. All right. But pretty much what the efficient markets hypothesis, the semi-strong form says, is that this reaction is done very, very quickly, and the new price adjusts very quickly. All right. So how fast does this reaction occur? Well, it varies. Sometimes there's an overreaction and a correction. Sometimes there's a delayed reaction. But pretty much the reaction is pretty like the pink line. All right. Most of the time you'll see kind of more like the pink line. And in fact, nowadays, information about companies and stocks 40 years ago, you would wait for the newspaper to wake up. You'd do a lot of your analysis in the morning. Market opens at 10 o'clock. Now it opens at 9:30. But at 10 o'clock, you might trade based on your analysis that you did that this morning. But nowadays, with the internet, information comes out really quickly. In fact, when a earnings report is filed at the SEC, what you find is that those earnings reports are downloaded by computers instantly. Within milliseconds. They analyze the language in those computers much faster than humans can do. Milliseconds, and do trades based on that news. And the implication of that is that prices are reacting very, very quickly within seconds. Yeah. And this also spills into front running. Basically, the most common example of this is traders buy up shares of a company that might be added to an index. So basically, even when a stock is added to an index, there's usually a bump in the stock if it's added into an index. But there'll be some arbitrage where some people have taken advantage of that. So, market seems to do a relatively good job at adjusting the stock's valuation. It's not perfect, all right? And it does have problems with developing an overall valuation for the stock or for the stock market as a whole. All right, what is the fair value of the stock market as a whole? There's different opinions on that. All right, and different ways of measuring what fair value is of the stock market as a whole, and there's different ways of measuring what the fundamental or intrinsic value of a stock is. All right, so what we're not saying is that the market is always rational, or that a stock is always near its intrinsic value. But what we are saying is that the use of information to try to outperform the market, that information that's publicly available, cannot be used through something called quantitative analysis to basically outperform the market. All right. Burton Malkiel, who's a finance professor, points out that 2/3 of professionally managed portfolios are consistently beating by a low cost index fund. He wrote a book, the Rain and Walk book, wonderful reading. It's been out there for many years, many editions. All right, and basically, securities are accurately priced, and in the long term, the returns are consistent with the level of what's called systemic risk that's undertaken. All right. Portfolio managers do not possess any private information, generally speaking, that is not already reflected in security prices. All right, so let's kind of take a little look. Active versus passive funds. Here's the percentage of active funds that outperform basically their benchmark or the index by category over a 1 year period of time. This is calculations as of 117. Over the last year, most active funds underperform. Here in the mid cap growth, there was a little bit higher percentage in terms of outperformance, and here in diversified emerging markets. But if you look at, let's go to 10-year outperformance. Only 11% of large cap stocks, only about 20% of mid cap value, mid cap growth mutual funds outperformed the indexes. And even in the international space, not a lot there. And even in the bond space, not a lot there. And the further you go out, typically the lower the percentages is. If you look and you break this between low cost funds and high cost funds, what you find is that the high cost mutual funds have an even lower 10-year percentage. The lower the cost of the fund, what you end up with is a little bit better percentage. But still, every category except one here had less than 50% success rate, and that was only for low-cost bond funds. Now, the strong form of the efficient markets hypothesis incorporates both the weak form and the semi-strong form, but then it goes further. It says that security prices fully reflect all public and private information. So even a corporate insider cannot make abnormal profits by using inside information about the company. And that inside information is basically information that's only known to several people inside the company, usually the corporate officers and directors. It's not available to the general public, and in fact, it's not supposed to be available. If you trade on public information, on inside information, and you're not an insider, you can go to jail. You're not supposed to trade on inside information. That's a violation of securities laws. Now, related to this is the unexpected portion of news that comes out is results in changes in stock prices. That's called a random walk. The prices walk up and down. We don't know where they're going to go. The news that arise, we don't know what the new news is going to be. We don't know what the news tomorrow will be about a company. All right, and security prices adjust to the arrival of that news. So basically, a random walk says news is random, and therefore the price adjustments are fairly random, and we really can't forecast the specifics of what's going to happen in the news very well. What we can do is control what we can control. Now, here, Cartoon says, wow, the Dogbert for investment funds has higher fees than any other. Dogbert says, it's true. That's how you can tell it's the best fund. I'm in. Are you diversified? Yes, I have suckers of all types. We want to be able to control costs. Now, I'm going to keep going here. I've got another slide presentation. For those of you stuck for the good stuff, I'm going to review class preparation assignment. So, go to the slideshow, play it from the start. We're actually going to review the questions. There have been many stock market downturns, likely about 15 to 20 of them just in the last 100 years that have been greater than 10%. But why? What is a black swan event different from the stock market downturn? And basically, black swan theory, basically it's a high impact, significant downturn in the markets that's hard to predict, and it's kind of a rare event that's beyond what we would normally expect. Okay. Here's a very interesting slide that I saw. I pulled it up, and basically at the beginning of 2017, this firm was saying, here are all the types of things that could happen in 2017 that could be black swan events. Iran, U.S. Escalates, Venezuela defaults, large-scale water contamination, riots in Chile, Russia pushes into Ukraine further, and it disrupts iron ore production. Any economic downturn in any of the major commodity-consuming nations, escalation of the trade war with China leads to geopolitical tensions. The model Elon Musk delivering the Model 3 on time or a battery breakthrough. All of these affect prices in some way. I would not call any of these black swan events because it's not going to have a huge impact on the overall market. Or maybe they would, but these didn't happen. So it's very difficult to predict black swan events. 9/11 was certainly one. The Dow dropped 14%, the S&P 500 dropped around 9-10% in the week when trading resumed. All right. And the great financial crisis, which has a lot of reasons behind it in terms of what happened. And this chart just goes through all of those reasons, and I'll leave these slides up on for you in Blackboard if you want to track all this. But basically, the black swan event, when it happened, led to a stock market fall, a global recession. Triggers was a money supply stock. Financial services companies were really on the brink of collapsing, and there's a credit crunch. A lot of companies, like even General Electric, were unable to get credit at times. So a lot of different problems that occurred there. And of course, the coronavirus. You actually have a lot of articles. If you type into your Google browser, coronavirus black swan, you have articles saying, this is not really a black swan, because there were people that were saying that, hey, this could happen. And I would say, yeah, there's always people that will always be out there predicting that catastrophes will happen. And certainly a global health crisis or pandemic is one of those that people have been warning about, but nobody really knew when it was going to happen or how severe it would be. So for that reason, I call this coronavirus, COVID-19 pandemic, I call it a black swan event. Some people would call it a white swan event or a gray swan event. To me, it's a black swan event. And what do you do when you get black swan events? Well, you stick with it. All right. Here are a whole bunch of different events that happened all the way back to 1871, and here's the stock market going up and down and up and down and up and down and the like, all the way through 2007, and it just pays to stay invested through the thick and thin. All right. Another question is, what is a PE ratio? How is it determined, and is it based on the past 12 months earning or the future 12 months earnings, or does it depend? Well, the PE ratio is simply the share price divided by the earnings per share. And to get earnings per share, you divide the net income of the company by the number of total shares that are outstanding for the common stock of the company. So you have a couple formulas here that you could actually use in order to do that. If the price of the stock is $50, if the earnings per share is $5, then the PE ratio is 10. That's simple. Now, actually, PE ratios, for example, the S&P 500 PE ratio, where they compute it for the average of all stocks in the index on a market cap weighted basis, basically you can use forward PEs or historical PEs. So what's called trailing 12 month TTM PEs. And the average, typically the forward PE is higher than the historical PE because typically earnings go up over time. Earnings can go up. Typically, there's a little bit of an over exuberance in terms of where earnings are going to be, but a lot of times you'll see that the analysts are predicting that earnings go up significantly. Now here's the median forward PE for the S&P 500 going back to 1981 when it was really low. It was down here below 8. And then it went up here by 2001 or so. It went to 22. This is the forward PE ratio. And here in 2017 or so, it was somewhere around 18. Here's the S&P 500 PE ratios, the trailing, and then the forward-looking PE ratio. The forward-looking PE ratio is lower because people are projecting earnings to be higher. All right. So typically you'll see the forward-looking PE ratio be lower. You can also do forward and historical PE ratios for other indexes. Here's the Russell 2000, the small cap index, the Russell 2000 growth index, small cap growth, small cap value, and you see how they vary over time. All right. Typically ratios go up and down together, but typically growth stocks have a higher PE ratio than the overall balanced or core, which has a higher PE ratio than values stocks do, as we've studied in the past. Here's the forward PE ratios for the Russell 2000 and also for another small cap index called the S&P 600. Now these indexes are comprised differently in terms of the number of stocks and also what stocks fit within small cap universe. And what you can see is that the PE ratios are different because the indexes are constituted differently. Describe how the Shiller PE ratio is determined. Describe it in your own words. Well, it's simply, basically, it takes the average of the S&P 500 index basically takes the current price divided by the trailing 10-year average earnings, but those average earnings are adjusted for inflation. So earnings from 10 years ago are adjusted upward for inflation. So is 9 years ago earnings 8 years ago. All right. Now you can use the SP10, which basically takes an average over 10 years. There's also, you could do what's called the SP15, very rarely seen. You see a lot of data on the SP10, however. And as we've discussed in the past, there's a correlation when you have high high CAPE10 or the high Shiller PE10 ratios, you're going to tend to have lower returns. So high P ratios here, lower returns. When you have a lower ratios, you tend to have higher returns. By the way, what is the Shiller PE ratio today? I'm kind of curious. So we're going to type in Shiller PE10, go here, and we'll just pull up this website, and it says that as of today, at 4 o'clock p.m. here on Thursday, April 2nd, so the market has closed in Eastern Time. The market went up a little bit. The Shiller PE ratio is 23.85. Going all the way back through history, the minimum and maximum. The median has been around 16, the mean a little bit higher than that. If you were to take this back only 50 years, you'd find that this is more like 17, 18. But we still have the Shiller P ratio for the S&P 500 index that indicates a little bit of overvaluation. I would caution, though, that some of the accounting formulas have changed over time, especially around 2000-2003 period, and as a result, the PE ratio, there might be some justification for the PE ratio being a little bit higher. All right, so back to our slides. All right. And here's just another way of looking at when you have a low starting PE ratio, what is the average real return? Nominal return minus inflation. The average is pretty high, 10.3. And when you have a higher PE ratio in this range, what is the average 10-year return? Only 0.9. Again, I would caution that because of some accounting adjustments, people might say, well, maybe 23 nowadays is more like 18 where it used to be, and maybe the average return ought to be 5.3. And Shiller has actually a slightly different index that he put together a couple years ago that basically takes into account those adjustments. Here's just another way of looking at the PE10 and looking at the means of it. And here's the mean level of valuation all the way back to 1871, I believe. And then you see above and below the mean, and for much since 1990, we have been above the mean except here in the great financial crisis. And right now we are probably around 23. This chart doesn't tell us exactly where that is, but we are probably down here, still somewhat above the mean, but not as high as we were at one point, just the beginning of this year. How does tactical asset allocation differ from strategic? Well, and basically this is bonds, stocks, domestic stocks. It's varying the asset allocation, more foreign stocks, less foreign stocks, less foreign stocks. Go from bonds, less bonds, more bonds, even more bonds, and domestic stocks. We're going to add more stocks and less stocks and then go less again. So basically it's predicting how well asset classes are going to turn and changing the asset allocation, giving the manager the discretion to do that. That's tactical asset allocation. Here's just another example of here are the ranges of returns, and you could overweight. In this case, they are overweighting high yield bonds and U.S. bonds, and they're underweighting cash and investment grade bonds and developed market securities. They're overweighting U.S. stocks, that's U.S. stocks. They're underweighting emerging markets and the like. So a lot of firms do this differently. Here's annualized results of, this is from a Morningstar study. This is the actual number of funds that existed for the entire period. If we look at the 10-year period, the average return of those tactical asset allocation funds versus the returns of just the Vanguard 60/40 strategic asset allocation portfolio, which was used as the benchmark for this. Yeah, and you see a big significant. The number of tactical asset allocation funds that outperformed in 1 year, 3 out of 57, but over a 3-year period, not a single one. Now, obviously, the answers might be different for every 3-year period that you look at, but pretty strong indication that tactical asset allocation has not been working very well. So market timing is not easy. All right? Yeah. What is the Larry portfolio? We're going to get into that. How might the Larry portfolio be used? And might a version of it be used by a 22-year-old investor? So the Larry portfolio basically says we're going to take about a big part of our portfolio is going to be bonds. We're going to take short-term investment grade bonds and treasury inflation protected securities, put up 70% of that, and then we're going to divide the rest between small cap value, a favored asset class that's likely to have higher returns, and also emerging market funds. Now, the Larry portfolio came out about 2010, 2011. It was called the Larry portfolio by Jason Zweig, who's a Wall Street Journal columnist. He wrote a column about it, and ever since then it's been called the Larry portfolio. And basically, the idea of the Larry portfolio is we have all these big losses in returns here, and we have a fairly wide in terms of the bell curve here. And the idea of the Larry portfolio is we want to narrow the standard deviation of the possible range of returns by putting a lot of stuff in bonds. So this is just illustrating 15% U.S. small cap value, 50% international small, and 70% intermediate bonds. The concept is the same. The asset classes are slightly different. All right. So what we want to do is basically we want to get rid of these really long, big downturns and try to achieve the similar return with that. Why might the Larry portfolio not work as well as it was historically? Well, we've studied kind of that some of the factor results that we're seeing back in 2000 to 2010 may not pay out as well. Some of these factors may in fact be lower because knowledge of the factors exists. Even Larry Swedroe has done the research on this that shows that about 1/3 of the returns, historical returns of the factors, might be reduced by about 1/3 going forward. Also, the returns from fixed income investments are going to be a lot lower in the future. The Larry portfolio when it was studied was in a declining interest rate environment for the most part on average. And the result of that is bonds did extremely well in terms of their prices. We also know the past is not always the same as the future. So here's kind of an illustration of how a 70-30 portfolio might be for a 40-year-old investment with moderate risk. I'm kind of taking the Larry portfolio principles, but I'm applying it to somebody who's not retired yet, someone who's younger. I'm going to put 35% in small cap value, 15% in international developed markets small cap value, so Europe, Japan, Australia, New Zealand, 20% in emerging markets value, and actually since 2018 there's now a dimensional mid-cap, small-cap value fund, but we don't have data on it going back a long way, so I'm just using the emerging markets value fund. 15% in TIPS, and 15% in 5-year U.S. Treasury notes. And I actually did this, I used a little bit different data on the bonds, but it was pretty close. And I said, how did that portfolio return from March 1st of 1997, which is the data we have going back to that point, through March 31st of 2019, a year ago? Well, this 70-30 portfolio compared to owning a portfolio of 90% S&P 500, which is 80% of the total value of the stock market on average, and only 10% of fixed income. All right. So outperform that because you're using all these factors and this really strong factor tilting, even though you have 30% fixed income investments. The standard deviation of the portfolio is about the same. The growth at 10,000, just see here, almost a 2% difference. Look what the difference in value of the growth is because of the compounding nature of the extra returns. The best return, 27.4%. The worst 5-year return was 0.21%. The best return of this portfolio is 21%, but the worst 5-year return, average annualized return, minus 5.5%. So that's minus 5.5% per year for 5 years. That's a pretty big downturn. So I also then took this forward and say, what about through the end of March of this year, 2020, when I'm recording this video? It's only a couple of days ago, all right? And obviously the market went down, and actually value stocks went down a lot further than growth stocks, and small cap stocks went down a lot further than large cap stocks here in the first part of this first quarter of this year. But still, over that period of time, there was an outperformance. It's only 0.9%. Standard deviation still remains about the same. So again, here are the funds used. I'm not saying that I would use these again, but just to show you the data, yeah, again, uh, over most time periods, not certainty, even over a 20-year time period, but a high degree of probability that with value tilting that you can outperform. And even if you lower the over allocation to equities, increase the fixed income allocation, that is going to help you guard against a Great Depression or a Great Recession like 2008, 2009, or what we're in right now, and I'm not sure yet what to call it because I don't think we've seen the bottom. So, hope you enjoyed the video. Hope that you do great on the class preparation assignment, especially since I kind of went over the answers. Put all those answers in your own words and look forward to reading the results. Thank you. Hey, 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 the bear is leaving.